It's a random Tuesday afternoon. You didn't plan to check your investments. You were just bored, scrolling, tapping. Then you open your investing app, and there it is. Red. Down 2.4% today. Down 6% this month. You feel it immediately, that subtle drop in your stomach. It's not panic exactly, it's discomfort. You start thinking, should I move it to cash? What if this keeps falling? Did I start investing at the wrong time? You switch apps. News headlines, market uncertainty, investors brace for volatility, experts warn of possible downturn. Now your brain is fully activated. It feels urgent, like you need to act. Now imagine someone sitting next to you quietly. They don't argue, they don't lecture, they just turn their phone toward you and show you one simple chart. It's messy, it's full of dips, but zoomed out over decades, and suddenly your breathing slows because you realize, oh, this is normal. That's what we're talking about today. The one chart that once people truly understand it changes how they feel about investing forever. Let's walk through it slowly. The chart itself. Picture a simple line graph. At first glance, it looks chaotic. Sharp drops, sharp recoveries, jagged movement. But then you zoom out. 5 years? 10 years? 20 years? 40 years? And suddenly, something fascinating happens. The chaos shrinks. The line tilts upward. The dips become small bumps. The crashes become dense. And the overall direction becomes clear. Up. That's it. That's the chart. And that one visual does something powerful. It separates short-term noise from long-term direction. Why our brain panics anyway? Here's the thing. Your brain wasn't designed for stock markets. It was designed for survival. If something drops suddenly, your brain says, danger. It doesn't matter if it's a loud noise, a falling object, or a falling portfolio. The reaction is the same. Fight, flight, fix it. But investing rewards a completely different instinct. Stay. Wait. Trust the process. That feels unnatural, which is why that chart is so powerful. It overrides emotion with perspective. The zoom out lesson. When you look at the market over 1 month, it looks unstable. Over 1 year, it looks uncertain. Over 30 years, it looks resilient. That's not motivational talk. That's historical data. Think about major events, the dot-com crash, the 2008 financial crisis, the 2020 pandemic crash, inflation spikes, wars, political instability. At the time, each felt like the end. People were certain things would never recover. But zoom out, each crash becomes a temporary dip. That perspective is calming because it reminds you this isn't new. It's part of the pattern. Volatility is not failure. Most people interpret volatility as something going wrong, but volatility is actually the price of growth. If markets were stable and predictable all the time, returns would be lower. Uncertainty creates opportunity. Opportunity creates growth. The chart shows this clearly. The market doesn't grow smoothly. It grows through turbulence. That's not a flaw. That's the design. The real risk isn't what you think. Most people think the biggest risk is the market crashing, but historically, the biggest risk has been panic selling, because when people sell during fear, they often miss the rebound, and rebounds can happen quickly. Some of the strongest market days in history happened shortly after major drops. If you step out during the storm, you often miss the sunshine. The chart proves this pattern over and over again. Time changes everything. Here's something fascinating. Volatility shrinks over time. In the short term, the market can swing wildly. In the long term, those swings smooth out. If you invest for 1 year, your outcome feels uncertain. If you invest for 20 years, historically, your probability of positive returns increases dramatically. Time is the shock absorber. Time turns chaos into growth. Time is the quiet superpower of investing. Why this chart feels different? Because it doesn't rely on prediction, it relies on history. It doesn't say, this will never go down. It says, it has always recovered before. That's a powerful distinction. It doesn't remove uncertainty, it reframes it. You stop asking, what if it drops? And start realizing it always drops, and then it continues. That shift is calming. The emotional trap of watching daily. Imagine planting a tree, and every day you dig it up to check the roots. It would never grow. Checking your portfolio daily is similar. You magnify short-term movement, you exaggerate small dips, you create emotional volatility. But when you step back and look yearly, or even better, decade by decade, you see the trend, and the trend matters more than the noise. The power of staying invested. There's a simple phrase investors repeat: time in the market beats timing the market. That's not just catchy, it's statistically supported. Trying to jump in and out often reduces returns because nobody consistently predicts highs and lows. But the chart shows something comforting. Those who simply stayed historically did well, not because they were geniuses, because they were patient. What this means for you. If you're investing for retirement, financial independence, long-term goals, then daily fluctuations matter less because your timeline is long, and long timelines absorb short-term shocks. The chart is proof that patience compounds. The hidden gift of dips. This might sound strange, but dips are not just something to survive. They can be opportunities. If you're investing regularly, when prices drop, you're buying at lower prices. Over time, that can improve overall returns. But only if you stay consistent, only if you don't panic. The chart shows that dips are temporary discounts, not permanent destruction. The mindset shift. Once people see this chart, they stop asking, how do I avoid every drop? And start asking, how do I stay consistent enough to benefit? That shift changes everything, because investing isn't about eliminating fear, it's about managing it, and perspective manages fear. One final visualization. Imagine you're flying through turbulence. The plane shakes. Your instinct says something is wrong, but the pilot remains calm because turbulence is normal at high altitudes. Markets are similar. Short-term shaking doesn't mean long-term failure. The chart is your cockpit view. It shows the full journey, not just the bump you're feeling. That one chart doesn't guarantee the future. It doesn't promise smooth sailing, but it offers something powerful: context. It shows that growth has historically come with dips, that crashes have historically been temporary, that patience has historically been rewarded. And once people truly see that, they stop reacting emotionally to every red day. They stop obsessing over headlines. They stop worrying so much because they understand volatility is part of the process, not proof of disaster. So the next time your portfolio drops, zoom out. Picture that chart stretching over decades and remind yourself you're not investing for